All right, good morning, everyone. Welcome to the Alliance of Angels workshop on Startup Options 101. It's a privilege to have a couple of our sponsors, Gary Kocher from KNL Gates and Dunnell from BDO, to share their expertise and their advice with all of us today. And just before we start, some quick logistics. We ask that if you are not actively engaging with the speakers, please put yourself on mute, right? So we can have a quiet experience and everyone will be able to hear clearly. So we do ask that you stay on mute unless you are engaging. That said, right, the idea here is that we do want to have an interactive discussion. So if you do have something you want to ask the speakers, please feel free to, you can either just speak up. This is a normal Zoom meeting, just speak up and go ahead and share your question. Or if you rather, you can use the chat windows within Zoom to do that as well. Right. So, and before we go ahead, I'm going to share a few words about the Alliance of Angels. My name is Jane. I run this organization. It's made up of 140 angel investors. Every year we put about 10 million into 20 companies. Most companies that are fundraising from us, they're looking for a total of between $500,000 and 1.5. And our typical check size is 250 to 500. We are a sector agnostic and stage agnostic investor that focuses on the Pacific Northwest. And I'm sure everyone knows we're in the middle of public health situation. That said, there's fundraising markets have been very active and we are very much open for business. In fact, last year, we had roughly the same number of investments as we did in previous year. There wasn't really a slowdown whatsoever. So if you're an entrepreneur and you are interested in seeking us for funding, feel free to send me a note. My email's at the bottom right here. Or if you're an angel investor, I know there are some folks on the call who are interested in learning more about angeling. Feel free to send me a note. Happy to share a little bit more about our organization. All right, and with that, I'm going to stop talking, and I'm going to hand over control to Gary Kocher from KNL Gates.
Wonderful. Let's see if I can share my screen. All right, does that look good? Al, can you see my screen all right there?
Yep, it's looking good.
Good. Well, thank you, Jane. I liked the reference you made to angeling. I had never heard it used as a verb before, but I think it works really well. And I guess before Al and I jump into the discussion today, we can just give you a little bit of background on our personal backgrounds and our organizations. As Jane said, my name's Gary Kocher. I'm a partner with KNL Gates in Seattle. And KNL Gates is a global law firm. Our origins trace back to the 1800s here in Seattle, but it was primarily the modern formulation of the firm was started by Bill Gates Sr. And we've grown over the years to become a firm of over 2,000 attorneys with 45 offices around the world. Seattle is one of our largest offices in the firm. We've got 175 attorneys in Seattle, and I'm in our corporate transactional practice and work in the emerging growth and venture capital space. I've been with the firm almost 30 years, which time sure flies when you're having fun. And I've had a lot of fun working in this space and being a part of the Alliance of Angels going back to the day it was started 20 years ago. So we've seen a lot of interesting companies come through the Alliance of Angels and see the Seattle tech community grow up over that time period. And so that's a little bit of background on me and KNL Gates. Al, why don't you introduce yourself and BDO?
I'm Al Dunnell. I'm a tax partner at BDO.
And Al, you're a little muffled right now.
CEO is the largest accounting firm in the country. A lot of resources. That's what the area is.
Hey, El, you're still a little soft right now.
Is that better?
Yes.
Yep.
Okay. Comp and benefits. You know, we have a lot of specialties we work. I work primarily in the startup area, and
Yeah, it's still very muffled.
why don't we jump in and maybe I can invite a show.
Sounds
Okay.
good. Sounds good, Gary. Go ahead.
Okay. All right. So I'll turn to the presentation, and as EJ mentioned, we've got close to 300 people signed up today, which is surprising that stock options is that big of a draw. But I'm glad that you're here with us today, and we're going to spend the next 45 minutes or so talking about equity incentive plans. And we really would like it to be a conversation, and all the microphones are open. So contrary to some Zoom meetings you may have been on where the participants are muted, you're able to speak up and ask us questions. So please feel free to do that as we're going along. It seems as if the number of attendees today are divided primarily among entrepreneurs. So either people who are starting companies or part of an organization that is interested in equity incentive plans. And I'd say about 3/4 of the people signed up today fall into that category. And then maybe 1/4 of the people would fall into the investor type category. So we'll try to sort of talk to both perspectives. But again, please feel free to interject with your questions as we're going along. So today, what we're going to talk about are basically, you know, sort of a full range of issues surrounding equity incentive plans, how to establish and maintain them, what types of awards you can make under the plans, what's the tax ramifications, which largely drives everything here, the governance perspective and requirements, and then considerations on exit. And then we'll also leave some time at the end for Q&A, but again, please interject as we go. So why equity compensation? This is probably intuitive for a number of you, but basically what this does is it aligns employees with investors in their interest to make sure that people are motivated and incentivized to achieve good outcomes, primarily on an exit.
KML Gates law firm over there.
And if you're not going to ask a question, I would just remind everyone to go on mute. Stock, oftentimes in the startup scenario, is really the currency that companies have to attract and retain employees. Cash is scarce. You're trying to plow that into your product development, and so the equity incentive plan becomes one of the key components to attract your employees. And then there's the tax issues that basically offer the recipients of these awards favorable tax treatment if they're set up properly. And so we're going to talk about that today. The most common types of equity awards that are out there, restricted stock, which is basically just issuing someone shares at the outset. Stock options, which is primarily what we're largely going to discuss today. Stock appreciation rights, which is something that is like a stock option, but you don't actually get the shares. You just get the economic benefit of what an option would be. And then in a LLC setting, we have an equity award that's known as a profits interest, which is it's kind of a hybrid between an option and a stock grant or an outright equity grant. We won't talk too much about that because we're not going to focus on LLCs here. Most of the discussion will be for corporations today. But again, if you have questions on the LLC side, feel free to interject. The nice thing about a profits interest is it gives the recipient the upside of the stock, and you can get capital gains associated with that without actually issuing the underlying equity award. So as I mentioned, we're going to focus on options here today. And an option is basically a contractual right for an employee or another recipient to purchase the shares of stock of the issuing company at a fixed price. And the options typically will vest over time, and you can have different triggers for vesting. Most common is a time-based vesting, and you can have different time components. For example, you might hear of cliff-based vesting, which means you have to be an employee for a certain period of time before anything vests. And so an example of that would be if you have an option award that has a 4-year vesting schedule, but a 1-year cliff, meaning nothing vests until the employee stays with the company for a full year. And after that 1 year, you can have a shorter vesting increments, such as monthly or quarterly after that initial 12-month period. And so that's often referred to as a 1-year cliff, meaning you have to be there a full year before anything vests. And so in that example, you might say, on the 1-year anniversary, 25% of the option will vest. And then after that, 1/36 will vest each month thereafter. So at the end of 4 years, it's 100% vested. And that's just one example. Some people like to sort of back end load the vesting. So rather than sort of vesting ratably over time, it could have smaller increments, such as you could do 10% vests after the first year, 20% vests after the second year, 30% after the third year, and 40% after the fifth year. So it basically ties people to staying with the entity for the full amount of the vesting schedule. And that's known as sort of the golden handcuff concept associated with equity incentives. And again, that sort of gets back to aligning employee interests with investor interests, where you want to basically tie these employees and incentivize them to achieve, the operating goals for the entity, so that they stay through that full vesting period. Options usually terminate following a termination of service. And so what that means is if the employee leaves or gets terminated, unvested options typically expire on the day that they're terminated or their employment ends. And then there's usually a window period for someone to exercise the vested options. And there's both sort of tax reasons for that and business reasons for that. And we'll go into the tax reasons a little bit later. One thing I have seen now, there's generally been a move towards allowing employees to retain vested options for longer periods after termination of service now. versus 5 or 10 years ago, where it was pretty uniform that after someone left, they only had basically 90 days to exercise the vested options or they would go away. Now, companies are allowing employees who have been with the company for beyond a nominal period of time to retain those the vested options, on the theory that people gave up other opportunities and cash compensation to receive the options. And if they leave and the company is still a private company, hasn't had an exit, there's no market for that option. So they ought to be able to retain that option, the vested portion of the option, for a longer period of time. So that's one sort of change I've seen in the market over recent time periods. One thing to note is that if you hold an option, you're not a shareholder in the company until it's actually exercised. And so that has ramifications for capital gains and qualified small business stock, which we'll talk about a little bit later.
I have a question here on when the company is still not public and you leave, you just have 90 days to exercise the options. Since the company is not public, where can you sell the options to? Does that mean options become zero?
Yeah, you generally can't sell an option. So you either exercise it or hold it. In general, employee equity awards are non-transferable. So your question is, if you exercise the option, you're holding sort of illiquid stock, what can you do with it?
Yeah.
That's really the issue. There are some secondary markets that are starting to, provide, an avenue for employees in private companies to sell their restricted shares, but there's not a lot of liquidity, and there's very sort of minimal trading, and the valuations in that market kind of vary quite a bit. So those aren't really sort of great alternatives, but they are starting to develop right now. So really, yeah, I think the alternatives that you have as an employee are to either exercise and hold the stock until there is some liquidity event, either an exit or IPO, or you hold the option. And that's why, getting back to my comment earlier, companies are starting to allow employees to hold those options for the full term of the option after you leave, because there aren't really good markets to sell your stock. So the two types of stock options that exist are what we call non-qualified stock options and incentive or qualified stock options. And so non-qualified stock options can be issued basically to employees, directors, and consultants. There's no shareholder approvals that are required under the tax law, because these don't really offer any advantageous tax ramifications to the employees. And Al's going to go through some of those issues in a minute, or the tax implications. There's no limitations on post-employment exercise period, which is the topic we were just discussing. And so that 90-day exercise period that most stock options formerly had tie into the requirements for the tax requirements for incentive stock options. And there's no required holding period. Actually, I think I jumped ahead. Actually, Al, you were going to, I think, run through the tax implications of the ISOs and non-quals. So Do you want me to jump to the example slide, or do you want to talk to some of those points
I'll
first?
talk to some of these points. Is the sound better?
Yeah.
Okay, great. So the taxation of non-qualified options, there is no tax event when the option is granted to the employee. The tax event happens when the option is actually exercised by the employee, and that will result in ordinary income for the difference between the fair value of the shares on the date it's exercised and whatever the strike price or exercise price is. In a non-qualified option, there will be tax withholding. There'll be Social Security taxes due and federal withholding. And states will also want to tax that too. If there's an income tax in the state, it varies by state, and you'd want to look into how it's taxed, but generally the state will look to the number of days that the employee was in a state between when the option was granted to them and when it vests, and then they will apply tax. There'll be tax due to that state for that delta. And most of the time the companies will take care of that. But, you know, the thing to keep in mind is if an employee is in a state and then leaves the state, there's still might be some tailing taxation when they actually exercise. So that's one thing to keep in mind. The company gets a like deduction. So for the spread that's calculated, it's added to either an employee's W-2, or if you're a contractor, added to a 1099 where there would be no withholding, or if you receive options as a director, those are going to typically be on a 1099 also. The company will get a like deduction equal to the amount of income recognized. And then once the shares are sold, and that exercise date triggers the holding period of those shares. So once you exercise the 1 year hold to get long-term capital gains starts. If you hold it the year or longer, you're going to get long-term gain. If you sell the shares within a year, it'll be short-term, and that capital gain will be the difference between the fair value. Really, it's the fair value at the time of exercise versus the fair value when the stock is sold. And we'll get into an example on that in a minute. ISOs are taxed quite a bit differently, and as Gary had pointed out, only employees are eligible to receive ISOs. There's a number of limitations that need to be met, and typically if those limitations or requirements are not met, they're just treated as a non-qualified option and don't get the ISO special treatment. And here's a number of those limits. There are limits if you're a 10% or greater shareholder to keep in mind. And the duration is by law limited to 10 years, and also limited to that once you terminate, you only have 90 days to exercise, or it will become a non-qualified option. To get ISO treatment, you also have to hold it 2 years from the date of grant, or 1 year from the date of exercise. So if you're looking to get ISO treatment on an option, you want to make sure you're going to meet both of those thresholds before you sell the shares.
And one thing to keep in mind, so most employees want, I'm sorry, go ahead with the question.
Yeah, I just had a question on the you might be getting to this, but the very last bullet. So if you exercise an option, right, after a company goes public, and then you hold the option for a year, then you don't get long-term tax benefits from that, or am I misunderstanding?
Yeah, you should get, in that situation, you should get because you will have held the shares for 1 year.
Got
Yeah,
it.
so you
Yeah,
need
I
to hold 2 years after the grant and 1 year after exercise.
got it. I just wasn't sure about the not satisfied in an exit transaction. I think I got
Oh,
that mixed
so
up.
yeah, I was going to make that. That was the point I was going to make, is if the option is exercised in connection with the acquisition of the company. So let's say the company is acquired through a merger, for example, and the options exercised and sold in the acquisition, then you don't satisfy the 1 year holding period from the date of exercise. So even if an ISO is, titled as an ISO and granted as an ISO, you will not get ISO, the favorable capital gains treatment on that transaction. So that's, and that is a very frequent occurrence. Because most people are not exercising their options ahead of an exit transaction.
I guess in some circumstances, though, if the option was rolled, so if you had an option in a company and it was acquired by somebody else, and instead of cashing people out,
Yeah,
and they just roll them into the new, basically options into, have options into the new company, then you could conceivably meet those requirements.
right. And we'll go into that a little bit further detail when we talk about the exit scenarios. So. Yeah, so I don't know if we need to go into that level of detail. Let's see.
Yeah, there's just additional limits about you can't have over 100,000 of ISOs exercisable in 1 year. Again, if you go over that 100,000 limit, it'll become a non-qual for the piece that goes over that.
Yeah. And then our AMT, our accountants and tax lawyers, favorite
this is
topic, AMT.
This is definitely an area where people can get into trouble, because a lot of people generically just say if you meet those ISO requirements, there is no tax at the time of exercise, and that is not necessarily the case, because for quote unquote regular tax purposes, there is no event when you exercise. But for AMT, that same spread you'd pick up as if it was a non-qual. The difference between the fair value at exercise and the strike price is picked up as an AMT preference item. So if it's large enough, you can end up owing AMT on the exercise of an ISO. One benefit, if that does occur, is that you actually receive a credit for AMT in the future that you can use to offset regular tax liability. So it's kind of an acceleration of what the taxation might be. But again, if you're in a company and you're giving ISOs out, you want to make sure that there is education to the employees about what the tax effects might be when they exercise, because it may not just be a non-event.
Yep, and as you can tell, so it takes a little bit of tax planning here to achieve the ISO treatment, because you have to actually exercise the option and hold the shares for a while. So a lot of times you see this come up with people who have gone through this previously and have held options in companies that have been acquired, and so they sort of learn the lesson that there's a significant advantage, at least for the time being, where there's a capital gains benefit and differential from ordinary income to exercising those options ahead of time. And so, normally then people, who are sort of in that category often have some other tax planning that they're doing too. So this AMT issue comes into play more often than you would necessarily think. So. And then, Al mentioned, if you don't satisfy all the requirements for the ISO treatment, then basically it just defaults to becoming taxed as a non-qualified option. And Al, you might want to comment a little bit about what happens in that situation, and how the company typically handles sort of withholding and those types of issues.
Yeah, if that's the case, then that spread ends up being reported as income on a W-2. The one big difference is that there is no withholding on a disqualified disposition of an ISO. So there's no Social Security being withheld, and there's no federal income tax withheld. So an employee might have a fairly sizable tax liability at the end of the year because of that. So that is one benefit that you get with ISO treatment, is there is no withholding.
Okay, that's good
of
to know.
taxes.
All right, do you want to walk through the example?
Yep.
Okay.
So we have a couple of examples of just to show the differences. Exercise price of $3 a share. Fair value of the shares was $5 at the time of exercise. 1,000 shares are acquired on exercise, and the fair value of the stock when it was sold was $7.50.
Okay.
So in the case of a non-qual, as we discussed, there's no tax when it's granted or as it vests. When it's exercised, in this situation, the difference between the $5 fair value at exercise and the $3 strike price times 1,000 is ordinary income. So in this case, if it was employee, 2,000 would be reported on their W-2 and there'd be withholding. And the company would get a like $2,000 tax deduction. And then when the stock is later sold, there's a $2,500 gain, which is the difference between the $7.50 sales price and the $5, which was the value at the time of exercise. In an ISO context, there's no tax grant vesting or no regular tax event on exercise, but that same $2,000 difference that we calculated as a non-qual will be picked up as an adjustment for alternative minimum tax purposes, and could and could not throw somebody in AMT. This is one of those areas where you definitely want to try to plan around that to the extent you can. And in this case, for regular tax purposes, there'd be a gain of $4,500 that would get picked up, the difference between the $7.50 and the $3 strike price when the shares are sold. And like as we discussed before, it's non-qualified. It's if the disqualifying disposition rules kick in where they didn't hold for 2 years from the date of grant or 1 year from the date of exercise, then that same $2,000 spread we calculated as if it was a non-qual would get picked up.
One thing to note in this, in an exit scenario, let's say, you're exercising and selling in the exit transaction, this corporate deduction can oftentimes be very valuable, and it's an asset that the sellers of the business should be focused on and should make sure they're getting credit from the buyer for. The buyer will be the one who realizes the benefit of this deduction afterwards, most likely. So the seller needs to ask for that credit in a purchase price adjustment, and a lot of times that's something that's missed. And if you've got a large employee base with a lot of options, that deduction can be millions of dollars. So. Okay, so switching gears a little bit, or focusing a little bit on ways that people can either take advantage of the ISO treatment more easily, or even for non-quals to convert gain to capital gains. A lot of companies will permit employees to do what's called an early exercise. So you can actually exercise the option before it becomes vested. Normally, vesting means that's once you're not allowed to actually exercise until it's vested. But in an early exercise scenario, the company says you can exercise even before it's vested, and then you convert the award to restricted stock that continues to have a vesting schedule that mirrors the vesting schedule of the option, and the company gets the stock back if the employee leaves. But the employee actually receives the stock, and then the holding period for capital gains starts. Yes? Question? Okay. And one of the things that companies do to facilitate this is to allow people to pay the exercise price rather than writing a check. They can issue a promissory note to the company, so they don't actually have to come out of pocket. So this is kind of the best of all worlds. It's kind of a synthetic exercise of the option. And the promissory note would be payable basically under the same scenario that the option exercise price would have had to been paid. So, if someone leaves employment, or if there's a sale of the stock, i.e. the company's acquired, then that would trigger payment of the promissory note, and the promissory note would have a maximum duration of whatever the maximum duration of the stock option was, which would be typically 10 years. So that's a very nice sort of way for people to exercise the option. You receive the stock, you start the holding period for capital gains purposes for both a non-qual and a ISO. And it also allows the employee to start the holding period for qualified small business stock purposes. There is a tax implication on exercise if the fair market value of the stock is greater than the exercise price. So the maximum benefit, or the best time to engage in this type of early exercise, is when the fair market value is equal to the exercise price of the option. Because if the fair market value of the stock is the same as the exercise price, there's no income that's recognized on the exercise of the option. And then in which case, the employee will make a what's called an 83B election, which I know I saw a question in the chat about 83B elections. And so what that election entails is someone can, well, let me take a step back. The default rule for taxation of stock that's subject to a vesting schedule is it's taxed to the recipient at the time that the vesting is satisfied, or when there's no longer a risk of forfeiture of the stock. And so that would mean the stock would be taxed at the value at the date that it vests. In this scenario, the 83B election changes this default rule to say the employee can elect to be taxed on the value of the stock on the date it's received rather than when it vests. And what that means is someone's electing to pay tax on something that may still be subject to forfeiture in the future. But if the value of the stock is equal to the exercise price, there's no value that would result in income. So there's no downside to making the 83B election. And so you make the election to be taxed at the value at the date it's received. And since you're paying full value for the stock in the form of a note, there's no income. And so that's why this early exercise structure is really kind of having your cake and eating it too. It's the best of all worlds because there's no income to be paid. You start your holding period for capital gains and qualified small business stock. And then it still preserves sort of the same vesting schedule as the options. So the only downside here to mention is the promissory notes have to be what are called limited recourse, meaning there has to be some amount of recourse to that the company has to be repaid other than just pledging the stock as collateral. And what that means is, if the company were to, let's say, go into a bankruptcy proceeding and the value of the stock at that point is zero, there would be a potential for creditors of the business to basically say to the employees, you have to pay your promissory note as a debt that's owed to the company. So the bankruptcy trustee would be seeking to collect the note from the employees. But in order for this structure to be accepted by the IRS, you don't have to have full recourse to the value of that note. So let's just say, the aggregate exercise price was $1,000. The amount of personal recourse beyond the value of the stock, I think most tax advisors would say, needs to be somewhere between 1/3 and 50% of the value. So what that means is if the stock was worth nothing, the employee could potentially be on the hook for $300 to $500 of that $1,000 promissory note. That's again the extreme sort of downside scenario, but there's a lot of advantages to this structure. Which is
I'm sorry to interrupt. What about the case of a full recourse promissory note? Is that a thing?
There could be full recourse promissory notes, in which case the employee, in a bankruptcy would be liable for the full $1,000 of that note, as a personal obligation to the bankruptcy trustee. In practice, I've never seen this, a trustee come after employees for this. So I think it's a pretty sort of limited situation where this, and, when most startups go out of business, there's no formal bankruptcy. They just basically go out of business and, the creditors don't have any recourse and there's not enough assets to have a formal bankruptcy proceeding. But, I just, in the interest of full disclosure, that's a consideration that needs to be explained to employees, when they're considering this structure. And then, so I already walked through this 83B election. The 83B elections also apply in the situation where people receive a stock grant as opposed to an option. So I mentioned, back at the outset, you can issue stock directly. It doesn't have to be an option. The issue is that a recipient of stock they're taxed on the value of the stock when they receive it, if they make this 83B election. And, most people would, in a startup want to be taxed when they receive the stock rather than when it vests. because the value hopefully is going to be a lot higher when it vests. So you elect to be taxed at a time when the stock has a very low value. So that's what this 83B election is. And, you know, at the time when a business is initially formed and it's a start, you know, pure startup, that's when you have the most ability to issue stock directly as opposed to options, because at that time, you know, the stock has a nominal value, so you can receive, you know, a grant of stock that has a nominal value, so you elect to be taxed at the time on the nominal value, and then everything from there is then all capital gains. And so these are just the advantages and disadvantages that I described. Valuation is another big topic that, you know, we've sort of referenced. Options, ISOs and non-quals for employees have to be granted with an option that has a exercise price equal to the fair market value of the stock on the date it's granted. And so this is a relatively new development when this new section 409A was introduced into the tax code, which was about 10 years ago, which was viewed as sort of a way to regulate companies that were attempting to basically issue deferred compensation or allow employees to sort of time the receipt of income, which the IRS generally doesn't like. And so options were kind of swept up into this deferred compensation. And so most people now are familiar with this reference to 409A because it's become so pervasive. And so what it's resulted in is kind of a new sort of group of service providers that provide these valuations for companies so that they can satisfy these this section 409A. Al, do you want to talk a little bit about the 409A requirements?
Yeah, I mean, typically you just want to hire a qualified appraisal. People are always trying to do workarounds on that, as far as you can look to recent transactions to try to establish, you know, if it's been close to a year since you've had a 409A. You know, sometimes you can just look to what, if there's been a recent transaction, what the value of that share sale was, to help substantiate what the current fair value is. But you definitely want to have some documentation in your files as to what, you know, what a good valuation is.
Yeah, and it falls into what's called a safe harbor, meaning that the IRS will not challenge it if you have a third party. You're not required to have a third party valuation, but if you don't, then it opens the door for a lot of dialogue from a variety of different sources. And first and foremost is the IRS. Second will be your auditors when they look at if you're having your financial statements audited, this will be a component that BDO and your other auditors will look at. Investors pay a lot of attention to this issue when they're doing due diligence. And then on an exit transaction, this is also subject of a large amount of due diligence. So having really good processes around your option grant process is really important from day one. And all stock awards need to be approved by the board. That's sort of the first sort of top line issue. You want to have an equity incentive plan that the options are awarded under. And so the equity incentive plan also needs to be approved by the board and then approved by the stockholders. And then this determination of fair market value also has to be documented around each and every award. You can adopt a valuation policy that helps you comply with 409A, and we have examples of those policies that we provide to companies. The valuation can be good for a year, but it's only under certain scenarios. So if you have events that occur throughout the course of a year that cause the valuation to change, you may not be able to rely on that valuation for that full period. So it's important to make sure that you're properly getting the board approvals and documenting them, because it's going to come up under all these different transactions and scenarios down the road, from investment rounds to your exit scenario. So some of the other governance issues that come up are when you have kind of conflicting documents, and that often occurs, when you have sort of discussions around employment agreements for, particularly senior level people who negotiate certain transaction or certain components for their equity and their option awards, and that may differ from what the actual equity plan says, or what their award agreement provides. So it's important to make sure that all of those pieces work together and are consistent. And then the other sort of paramount consideration is making sure that you have a very sort of clear statement in your equity plan and in your option awards of what happens when there's an exit scenario, because any ambiguity around that, or again, any conflict between what a plan might say and an individual's employment documents might say, can cause big problems when you go to have an exit transaction. And so it can definitely result in tax problems for both the recipients and the entity itself. And so generally what you want to have is a plan that says, when there's an exit, you have basically 4 scenarios that are not necessarily mutually exclusive, but it's clear that one of these events, all of the options will be dealt with under one of these categories, and they can either be assumed by the buyer, they can be either accelerated or not. That means unvested options could automatically accelerate on a change of control or not, and providing which of those scenarios happen. And a lot of times you'll hear the situation of a double trigger acceleration versus a single trigger acceleration. And what that means is a single trigger means if there's an exit, change of control, all the options accelerate. So the trigger is the acquisition. And employees generally like that. Investors don't like that, because what that means is then the buyer, then to the extent that they want to retain these employees, they're going to have to basically re-incentivize them and issue them more equity awards on the other side of the deal to basically keep those people around and incentivized. And not to mention that a number of the employees may have received sort of enough, in terms of compensation, that they may just decide to walk away. Investors generally don't like to see single trigger acceleration, and instead prefer double trigger, meaning there has to be not only a change of control, but that the employee would lose their employment following. So if they have an opportunity to remain employed and then the options continue in the employer, then there's no acceleration of vesting. And then another component on an exit is a net settlement, meaning the options don't have to actually be exercised. The employees just get cashed out for the net difference between the exercise price and the transaction value. And then the most important thing here is that there's a cancellation of any unresolved options. So if the acquirer doesn't assume them, they're either accelerated or they're cashed out. There can be no sort of unresolved options that basically don't allow the acquirer to be in control of how the options are treated in an exit. So that's a very, very critical component of any equity incentive plan. And then lastly, just to touch on a couple of other issues. So we've been talking primarily about US focused issues. Taxation of the options are different outside of the United States. And so you can have both non-US employees that are receiving options under a US plan. And then you could also have non-US companies that are issuing options to US employees. And the first situation where you've got US companies issuing awards to employees outside the US, those generally, they'll follow US sort of tax laws for the most part in that situation, and you don't have as many issues. You have bigger issues where you have non-US companies trying to issue company options to employees in the US, and then both the non-US tax issues and the non-US corporate issues are oftentimes very different than the way US the US tax regime treats those things. So it's really important to get good advice in those situations. And then lastly, I just mentioned, and I mentioned this a couple times in the conversation, the QSBS consideration, and QSBS is a shorthand for qualified small business stock. And that's a provision that basically allows people to exclude up to $10 million of gain on capital gains on stock in qualified small business entities. It's only available for C corporations. It's only available if you hold shares for at least 5 years. And so that's why it's important to actually exercise an option and get that holding period started if you want to be eligible to qualify for this. But it's a huge tax incentive that's available right now. A lot of people are very interested in trying to qualify for it. So that's where the early exercise of the option program comes into play and is beneficial. So Al, anything else you want to mention just on an overall basis?
I think that covers it.
And I'm sorry we had to kind of rush through that at the end, but we'd be happy to open the floor up for some questions on any of the topics that we touched on.
I see that Blair has his hand raised. If you'd like to go ahead and ask your question.
Okay, thank you so much. This has been really wonderful today. Thank you for your time. So I sold an S Corp a few years back, and I would just say that the one thing that I wished I'd done a little differently was not put out so much stock to the founders in the beginning without them having to jump through some markers. We had one founder who did not participate much over the course of the business. So that was a little difficult then now I have a new startup, and I actually just bootstrapped it as an LLC to see how it would fly. It's going pretty well, and I have people working for me for way under market value for their skills and talents. So I want to move into an S Corp when I go for funding, or to C Corp when I go into funding. But I want to keep to being LLC now. What would be the smartest thing that I could do to sort of let them share in the pie at this point before we move into being a corporation?
Yeah, so an LLC, I mentioned at the outset, there's this alternative known as profits interest. First of all, you can grant an option in an LLC, and it's, they don't have, you don't qualify for the incentive stock option tax treatment in LLCs, so everything would be taxed as a non-qualified. So basically, that's going to result in ordinary income to the recipient. The profits interest allows the recipient to achieve capital gains in an LLC, kind of on the same basis as a stock option. And the profits interest, you basically issue an award, and they're only entitled to participate in distributions to the extent that the valuation of the company exceeds the fair value on the date the profits interest is awarded. So it's kind of the same concept of a strike price and an option, that's established at a fair market value. So you could issue profits interest in the LLC. And then I guess to the extent that that's held for more than a year, then that would qualify for the capital gains treatment. And if you were later to convert to a C Corp, you could convert those awards into, I guess, equity in the C Corp. And but that would be the best, most tax advantageous way to issue an award in the LLC.
Thank you so much. Great, wonderful.
I think we have time. We could probably take one more quick question. I see Daniel has a hand raised. Go ahead.
Hi, everyone. Thank you so much for taking my question. It relates to actually the slide that's currently on the screen. We have two consultants that are 100% commissioned for us, one in Canada and one in the UK. Can you expand a little bit on the taxation and employment securities comment in the second sub-bullet around US companies granting, in this case, it would be stock options to these non-US consultants? I know they won't pay employment taxes here in the US, but can you let me know what other considerations we need to be thinking about?
Al, do you want to comment on that, or would you like me to?
Yeah, you'd want to check to see how that's going to get taxed. I think in certain circumstances, countries will actually tax it on grant. And so you definitely would want to tip off the employee that there might be a tax event up front, and I think the UK might be one of those.
Yeah, and you need to qualify the plan in the UK before you issue the awards to the UK residents.
Okay, great. Thank you so much.
Yep.
Okay. All right. I think we're all the time right now. I'd like to thank Gary and Al for spending an hour with us and sharing with us all their detailed expertise. It's a very informative session. And this is the slide that has the emails. Feel free to reach out to either of them if you have any questions. And we'll also be sending the slide deck out to everyone who signed up afterwards. So with that, I'd like to thank everyone for joining us today. Have a great rest of the week. Thank you.
Thank you.
Thank you.